Welcome to our Financial Markets Market View presentation. We'll be analysing the currency pairs AUD and against USD and AUD against JPY. These currencies are found in the foreign exchange market, which can be described as a global financial market for the exchanging of currencies, including buying and selling. A good question to ask is how a country establishes its foreign exchange market currency value. There are a number of economic factors that contribute to this, including relative interest rates, relative inflation rates, commodity prices, relative economic growth rates, and other factors such as exchange rate expectations, official intervention, and global speculation and investment. This will be explored in detail in this presentation. The Australian currency has changed from pound to dollar in February 1966. As stated by XC's currency rankings, the most popular Australian dollar exchange rate is the USD to AUD rate. The AUD is the fifth most traded currency in the world and switched to a floating exchange rate in 1983. A floating exchange rate meaning it can fluctuate in value. Due to Australia's substantial raw materials exports, the AUD is heavily affected by the Asian import markets such as China and Japan. This makes China Australia's largest export market and Japan the second largest. The Meiji government in 1871 officially adopted the Japanese yen, yen meaning a round object. As stated by XC's currency rankings, the Japanese yen is the third most traded currency in the world. Japan switched to a floating exchange rate in 1973. Again, the floating exchange rate means it can fluctuate in value. In June 1785, the Congress of the United States authorized the change of the new currency, the US dollar. As stated by XC's currency rankings, the USD is the most traded currency value in the world. Several currencies use the USD as their official currency, including East Timor, Ecuador, El Salvador, Zimbabwe, and more. Today, there is $1.54 trillion of US currency in circulation. So, the established effect of relative interest rates involves the following, where there is an increase in a nation's interest rates, generally leading to a rise in capital inflow, which increases demand for the currency, while at the same time discouraging capital outflow, therefore decreasing supply of the nation's currency. If Australia has high inflation than its counterpart, there will be less demand for exports and more demand for imports. Less demand for the Australian dollar, causing a downward shift in the demand curve from D1 to D2. And more supply of the Australian dollar, causing an upward shift in the supply curve from S1 to S2, which in turn creates a new equilibrium exchange rate, being ER2.
According to the Reserve Bank of Australia, the current Australian interest rate set as 1.5%. The United States interest rate was last recorded at 1.25%. As the interest rate in the US is lower than Australia, investors will choose to invest funds within Australia, as they will see more of a return on their investment compared to if they invested in the USD. Because of the Australia value will increase as a result of a higher demand, while the USD will begin to depreciate as the demand falls. As shown from the graph, it can be seen that the Australian dollar has been steadily increasing against the USD dollar since January of 2017. As of September 2017, one Australian dollar equals to 0.8 US dollar. In previous years, the US was Australia's third largest foreign exchange trading partner with a total worth of around 65 billion. Australia's goods exports to the US totaled around 13 billion, and Australia's total imports from the US were around 55 billion. As stated earlier, if Australia has higher inflation than its counterpart, they will have less demand for exports and more demand for imports, as it becomes more costly for international buyers, which creates less demand for the Australian dollar but more supply of the Australian dollar. As shown from the graph, one top Australian inflation rate have been declining from the year 2000 onwards. As stated by the Reserve Bank of Australia, the current inflation rate sits at 1.9%. The current inflation rate for the United States is also 1.9%, as published by the U.S. Labor Department on September 14, 2017. The graph on the bottom shows that the United States inflation rate has also been declining early from 1.7% in 2013 to 0.7% in 2015. However, they have jumped up in previous years at 2.1% in 2016, and now the current is 1.9%.
Okay, so as shown from the graph on top, the Australian inflation rates have been declining from the year 2000 onwards. As stated by the RBA, the current inflation rate sits at 1.9%. Current inflation rate for the US is also 1.9, published by the Labor Department. The graph on the bottom shows that the US inflation rate has also been declining early from 1.7% in 2013 to 0.7% in 2015. However, they've jumped up in previous years back up to 2.1%. Okay, so the CPI, or Consumer Price Index, is a measure that examines the weighted average of prices of goods and services, or a basket of consumer goods and services. The CPI in the US increased at 246 index points in August from 244 back in July. The CPI has averaged 109 since 1950 in the US, all the way up to 2017, where it reached an all-time high, 255. In August, it recorded a low of 23 index points in January of 1950. So, moving on to inflation rates. As mentioned previously, a high inflation rate corresponds to depreciation in currency due to a reduced demand for exports and a rise in imports, leading to a greater supply of the currency on the foreign exchange market. The Australian inflation rate is generally higher over the few years than the US. So if this continues while appreciating at the moment because of low inflation rates, Australia will experience an appreciation while the US dollar inflation will begin to drop. Okay, so moving on to commodities, which can be defined as any raw material or primary agricultural product that can be bought and sold, including oil, meat, gold, and etc. Australia is a major exporter of various commodities, including materials and agricultural products. If Australian exports become more expensive because of inflation rates, international importers of Aussie goods will turn to other countries because of this. An increase in commodity prices will increase the value of the Australian exports, resulting in an appreciation of the Australian dollar due to the higher demand. However, despite that, there is an appreciation. Trading partners cannot use other suppliers as commodity prices are constant worldwide. Continuing with that, commodity prices in the US decrease, the value of the US dollar decreases, so the same sort of thing. As a result of this, the US dollar would begin to depreciate against the Australian dollar because they rely on the minerals and fuels to provide vehicles. Currently, commodity prices in the US are low. Australia can take advantage of this as the US exports will now be cheaper than purchasing them within Australia. Alright, moving on to interest rates. As previously mentioned, the RBA states the current interest rate of Australia at 1.5%. In contrast, the Bank of Japan, the central bank, sets the interest rate at minus 0.1%. So what this actually means, it's a measure of increasing the economy in Japan. Basically, it's very enticing for companies to increase their investment spending because of these borrowing rates. They're not actually paying interest, they're getting money back on their borrowing. So it's actually a means of increasing the whole national economy. And finally, the Australian dollar against the yen is an exciting pair for its relation to risk. We applied a technical analysis of these from past price to detect patterns and predict changes. Comparing from 2016 to 17, the exchange rate of the Aussie dollar to Japanese yen will go up in the next 3 months. This may lead to more commodities in Japan, which increases exports in Japan and imports in Australia over the next 3 months.